Here to share his perspective on the global market is Jean-Yves Fillion. He's the vice chairman of BNP Paribas USA. Welcome. It's good to see you again. Thanks for coming down here and sitting on our set.
Thank you so much for having me, Scott.
So, what makes a market is, differing views on where we are. We just had a vigorous debate about whether it's time to be bullish or bearish. The bears had won out for a while, but how does the environment feel to you today?
The data of the week was quite positive. Inflation's coming down, probably at a faster pace than expected. Retail sales are coming down as well, but probably not as fast as one would have feared. And this U.S. economy seems to continue to be very resilient in spite of the headwinds. And I think this is what the markets are recognizing, right?
Yeah. Are you surprised by how resilient almost everything is? I mean, the consumer's been resilient, the economy's been resilient, the market's been resilient.
Not so much. Spending a big part of my time with business leaders. I was actually last week with some of the largest, tech CEOs. This economy continues to have strong fundamentals. Corporate balance sheets continue to be in a good shape, very liquid. The consumer continues to spend. And the velocity of capital markets here is just unprecedented.
Yeah, I mean, you are talking about some of the most well-known CEOs out in Silicon Valley that I know you've been with lately. What sense are you getting from them on enterprise spending? The very things that the market is concerned about that would be first hit in a more dramatic economic slowdown.
There is concern about the geopolitics and politics situation. We have to be very clear on that. It's in everybody's mind. However, I see them very involved and engaged in terms of investing, expanding internationally, by the way, where the bank is pretty well positioned to support them, having a presence in 62 countries in the world. What they need mostly is they still need lending and actually at times bridging to capital markets, expecting better conditions. They are very focused on the more, I would say, industrialized ones on, short-term financing, trade, receivable financing, supply chain financing. But I would say I would be remiss if I were not saying that given the uncertainty and the potential expected volatility, we've had unprecedented demand on hedging strategies. And Scott, across the spectrum, obviously it starts with rates, with currencies, commodities, given the status of energy and equities.
Okay, so since we're talking about demand for financing, let's talk about rates. Have we peaked? Do you think we have? Do you think the Fed's done? Let's start there.
I think central banks, and I'm putting an S here because I think there's a common view between the Fed and the ECB, acknowledge the good trend in terms of inflation. But when you look at inflation, I think we have to make a distinction between holistic inflation, between core inflation, and between services inflation. And this the latter is probably the most steady. However, I don't think anybody claims victory on this battle.
Yeah, well, that's clear. You're getting that, including from the Boston Fed president who was on our network today, Collins. Let's listen to what she told our Steve Leisman, and we can react on the other side of that, Jean-Yves.
3-month core is still at 3.4%, Steve. That's higher than we want. And so in order to get back down to 2% in a reasonable amount of time, we need to be patient and resolute. And I wouldn't take additional firming off the table. We need to look holistically at the data.
It's kind of the message you're getting from everywhere, correct? Too soon to declare victory, but we can afford to be patient.
There is always a debate about is 2% the proper benchmark going forward.
Well, what do you think? Because you hear Jim Gorman this week, who said what, maybe it's not. He said maybe 3%.
Then I think there is a good discussion. And I wish I had a crystal ball on this one, right? However, what I have more certainty about is this is the end of cheap money, and this is the end of cheap labor. The house view for 2024, we see the Fed and the ECB, sticking to their policy. Probably we've reached a stage where terminal rates are probably where they are, but we don't see any cuts until the second half of 2024.
But
and as you know, central bankers are fact-based and driven by data, then that's going to be the main driver in the next few months.
Do you think they cut because they can, because inflation's come down on trend, or do you think they cut because they have to, because the economy's weakened to the point that they have no choice?
And I think you are just highlighting the dilemma. They have to manage this very fine line between fighting inflation and keeping this economy going. I have to say, as it relates to this economy, this is such a resilient economy that they might have a bit more room to maneuver than the ECB might.
Who cuts first? Who cuts first, Lagarde or Powell? I'm putting you on the hot seat now.
I was going to ask you, actually. That's what I came over today. Well, listen, what's interesting to see here, there is convergence between these two central banks, in terms of money, first and foremost, in terms of oversight, supervision, in terms of monetary policy. If there is one difference still, the Fed has been using in their toolbox rate hikes, as well as unwinding the balance sheet.
QT, quantitative tightening.
90 billion monthly. The ECB so far has only or mostly used rate hikes, not yet unwinding the balance sheet, and this is what could be a differentiating factor.